Welcome to Keystone Property Advisors, where we equip you with the knowledge to make smarter property decisions. Today, we're tackling a mistake that blindsides countless aspiring property investors and even experienced homeowners considering renting out their property. Many look at a promising rental listing, see the potential rent, subtract the mortgage, and immediately declare it a cash flow positive goldmine. They see the income, but they critically underestimate or entirely overlook the expenses. This immediate, simplified calculation is not just incomplete, it's dangerously misleading. It's the hidden problem that transforms seemingly profitable ventures into financial drains, leading to stress, forced sales, and the exact opposite of wealth building. Whether you're a first-time home buyer considering renting out a spare room, a property investor eyeing your next acquisition, or an accidental landlord, understanding the true financial picture of your rental property is non-negotiable. The common mistake is focusing solely on the gross rental income and a few obvious costs, ignoring the multitude of smaller, often irregular expenses that chip away at, or even devour, your profit. Experienced property owners and savvy investors don't just hope for profitability. They calculate it rigorously. They understand that a rental property is not just a passive income stream. It's a small business, and like any business, it has a revenue side and a significant expense side. The underlying principle here is called net operating income, or NOI, and then ultimately, actual cash flow. People make poor property decisions because they lack this business mindset, treating a substantial investment like a simple transaction. They fail to account for vacancies, maintenance, capital expenditures, and even the cost of their own time or a property manager. This financial blind spot is why many great-looking properties turn into liabilities instead of assets. So, how do experienced investors approach this differently? They use a clear, structured real estate framework to dissect every potential income and expense. Let's break down how you can calculate rental income versus expenses step by step to reveal the true profitability of any property. First, determine your gross scheduled income, GSI. This is the total potential rent if the property is 100% occupied, plus any other income like laundry fees, parking, or pet rent. Second, account for a vacancy and credit loss. Properties are rarely 100% occupied all the time. Set aside a realistic percentage, typically 5-10% of your GSI, to cover periods between tenants or non-payment. Subtracting this gives you your effective gross income. Third, meticulously list all your real operating expenses. These are the costs to run the property, excluding debt service, property taxes, and unavoidable annual costs. Insurance. Landlord insurance is different from standard homeowners insurance and is essential. Utilities. If you, the landlord, are responsible for any repairs and maintenance, R&M. This is more than just emergency fixes. Property management fees. If you hire a professional, homeowners association, OHA fees, if applicable, advertising and marketing, costs to find new tenants, small unexpected costs. Fourth, set aside funds for GE capital expenditures, CAPEX. These are not daily operating costs, but significant, infrequent expenses. Once you have your effective gross income and total operating expenses, you can calculate your net operating income, NOI. That's EJ minus total operating expenses. Finally, to get your actual YJ cash flow, subtract your GT debt service, your mortgage principal and interest payment, from your NOI. This reveals the actual amount of money you're putting in your pocket each month, or conversely, what you're losing. Let's walk through a simple, realistic example to make this concrete. Imagine you're considering a duplex that rents for $1,500 per unit per month. Gross scheduled income, GSI, $1,500, unit x 2 units, Koti through $3,000 per month. A vacancy, allowance. Let's budget 5%, Pachwati. $3,000, Ank 0. 0.05, Kyuchi dollars, $8 side. Harsh income. AGI, $3,000, $150, $50 per month. Now, for expenses. Property taxes, $300 per month. Insurance, $75 per month. Utilities, landlord paid, $50 per month. Repairs and maintenance, $150 per month. Property management, 10% of collected rent, $285 per month. A capital expenditures budget, $100 per month. Total operating expenses, $300 or $75 to $50, $285 to $100. JJ9, $60 per month. Net operating income, NOI, $2,850, EGI, $960. Total operating expenses, $1,890 per month. Now let's factor in financing. Suppose your mortgage principal and interest payment is $1,400 per month. Monthly cash flow, $1,890. NOI, $1,400. Debt service, AG, $490 per month. In this scenario, after accounting for GAA expenses, including a realistic vacancy rate and funds for future big repairs, this property generates a positive cash flow of $490 per month. Without this detailed calculation, you might have just subtracted a $1,400 mortgage from $3,000 rent, seeing $1,600 and believing it to be a much bigger profit. This precise calculation gives you a clear, honest picture. Understanding how to accurately calculate rental income versus expenses is fundamental to long-term wealth building through real estate. Properties with a strong, positive cash flow are resilient. They provide a buffer against unexpected repairs or market downturns. They allow you to pay down debt faster, build equity more rapidly, and ultimately free up capital to acquire more properties, growing your portfolio sustainably. Ignoring these crucial calculations can lead to negative cash flow, forcing you to inject personal funds into the property, eroding your savings, and turning a supposed asset into a financial burden. Strategic property decisions are built on clear numbers, not hopeful estimates. Don't let hidden costs erode your real estate dreams. By diligently calculating every potential income and expense, you empower yourself to make intelligent, data-driven decisions that will serve your long-term wealth goal. Real estate is a powerful vehicle for financial stability and growth, but only if you approach it with the clarity and discipline of a strategic investor. Calculate wisely, invest smarter, and build your wealth through property with confidence.